In terms of the global trend, the first one, of course, we're just coming off a night of tariffs, global tariffs. Generally, that's going to impact how countries trade with each other.
Increases in tariffs, typically they strengthen the currency of the country that is introducing those tariffs in the short run, meaning you would expect that other currencies would weaken.
I think it does provide a very good opportunity for Chinese companies that are being hampered by all these tariff wars to then look at countries like Kenya, where they can be able to do significantly more international trade than they've done before. We've seen a relatively stable exchange rate for Kenya shilling against dollar, but with all of these external events happening, from geopolitical conflicts to tariffs changing every other time, and what impact they might have on things like the global interest rate environment, all those things introduce outlier external risks that can quickly have a very big impact on the domestic scene. And so for that matter, I think the risks remain the same, but they're not unique to Kenya. It's your interest rate risk or volatility thereof, and of course your exchange rate risk, at least on an outlook basis.
Fiscal slippage and the government spending more, which we should anticipate, then that could put pressure on interest rates. But with favorable liquidity conditions currently, we expect that you will have generally stable interest rates.
Whatever is happening in the US in terms of tariffs and the impact it might have on inflation, etc., and generally the US economy, potentially we could see that rates remain elevated. So then expect that you might see significantly more volatility in dollar interest rates. You could also see that dollar interest rates perhaps will remain more elevated, which is a slight change from when we started there and where we expected things to go. Domestically, I think we are still in an easing cycle. At least that's what the Central Bank of Kenya has communicated in the previous monetary policy statement. That's bound to continue, at least in the short to medium term, as they look to support credit growth within the economy.
We think that in 2025 you will have a rebound in private sector credit uptake, more so because interest rates have come off, and as borrowers become more familiar with the current lending rates, they may be willing to take on or go back to doing capital projects and borrowing from the commercial banks, and we expect that private sector credit growth will begin to pick up.